For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir Technologies continues to be one of the most hotly debated artificial intelligence companies among investors. On one side, there are those who firmly believe in its long-term growth potential and consider the stock to be a cornerstone of the next technological era. On the other, a large group of skeptics avoids it altogether due to its steep valuation and unpredictable trading behavior. Personally, I've generally aligned myself with the more cautious crowd, those who maintain a safe distance unless the stock falls to what could be considered a much more appealing price point. However, that stance is not set in stone. If the market were to correct and bring Palantir's valuation back to a level that aligns more closely with its fundamentals, I would be open to reconsidering my position. Recently, Palantir stock has faced notable downward pressure due to broader market volatility and a shift away from high-growth, high-valuation equities. At present, shares of Palantir are trading at approximately 25% below their all-time high. This represents a considerable pullback from previous levels and might at first glance appear to offer a buying opportunity. Yet the more pressing question is whether this price decline presents genuine value, particularly with the company set to reveal its Q1 earnings report on the 5th of May. History has shown that Palantir's stock tends to make significant movements following earnings announcements. What remains uncertain is the direction of those movements. Looking back at the company's performance throughout the 4 quarters of 2024, the stock saw an upward move after earnings in 3 of those quarters. However, in each instance, regardless of whether the reaction was positive or negative, the stock experienced a double-digit swing. This means that volatility is all but guaranteed, and any investors looking to buy in ahead of the earnings announcement should prepare for substantial price fluctuations, either to the upside or the downside. One reason behind these dramatic post-earnings moves may be the company's approach to financial guidance. Palantir's executive team is known for offering conservative revenue expectations, only to later surpass them when the actual results are released. This strategy of under-promising and over-delivering can be beneficial in the long term, as it helps maintain investor confidence and avoids the reputational damage that can come from missed expectations. For the upcoming earnings report, Palantir's leadership has shared expectations of 36% revenue growth for Q1. This is the same growth pace the company reported in Q4. Based on previous earnings cycles, there is reason to believe that actual results could exceed this estimate by a small margin, perhaps by a point or two. Still, the real weight of the report might not rest on the quarter's revenue numbers, but rather on what the leadership communicates about the company's outlook for the remainder of the year. Palantir operates in a space where macroeconomic sentiment plays a critical role. When businesses and governments are confident about the economy, they are more willing to invest in software solutions that promise long-term efficiency and operational optimization. But when there is hesitation or fear of a downturn, discretionary spending often takes a back seat. This dynamic could impact Palantir's guidance, especially given the premium nature of its product offerings. To illustrate how exclusive Palantir's software is, one only needs to look at its commercial client base. As of the most recent quarter, the company had 711 total commercial customers. These clients collectively generated $372 million in revenue during Q4. When that figure is annualized and divided by the customer count, it yields an average customer value of approximately $2.09 million. That level of spending effectively excludes many smaller firms and even some mid-sized businesses, positioning Palantir services as a luxury reserved for large corporations and government agencies. However, this exclusivity may also work in the company's favor. If potential clients view Palantir's solutions as indispensable, tools that enable them to operate more efficiently, analyze massive datasets, and make informed strategic decisions, then high pricing may not be a deterrent. Instead, it could become a justified expenditure akin to an investment in mission-critical infrastructure. Should this perception become more widespread, it might pave the way for more bullish guidance from the leadership, reinforcing the belief that Palantir's growth story is far from over. This scenario forms the optimistic view of Palantir's future. Palantir's cutting-edge software will become an essential asset for organizations looking to stay competitive. They believe that the company is building a foundation that will deliver massive returns over the long haul. And to some extent, this belief is reasonable. Palantir does have a powerful product and a growing reputation in both commercial and governmental sectors. However, the opposing view, one rooted in valuation concerns, raises some important red flags. flags. Despite the recent decline in the stock price, Palantir still trades at levels that many consider extreme. Its valuation currently sits at roughly 167 times forward earnings and 79 times sales. These are towering figures even in the realm of high-growth technology stocks, and when you compare this with its expected revenue growth of 36% for the current quarter, the disconnect becomes more apparent. To put things into perspective, most software companies tend to trade in a range of 10 to 20 times sales. That range reflects a more balanced relationship between price and growth. By contrast, Palantir's nearly 80 times sales ratio stands out as an outlier, one that could be difficult to justify unless the company was delivering explosive growth numbers, such as doubling or tripling its revenue from one quarter to the next. That kind of growth simply hasn't been part of the Palantir story. What this tells us is that investors have already priced in several years of ambitious growth into Palantir's current valuation. In order for the stock to settle into a more reasonable valuation, something closer to 20 times sales, the company would need to sustain a revenue growth rate of at least 40% for more than 4 consecutive years. And that's assuming the stock price remains flat during that time, which is an unlikely scenario given the dynamic nature of the market. Furthermore, this hypothetical growth rate is significantly higher than what the company's leadership currently anticipates. As a result, the most likely outcome from a valuation standpoint is that the stock will face selling pressure following the Q1 earnings announcement. In today's market environment, where economic fears and cautious sentiment dominate the investment landscape, stocks with rich valuations are often the first to be punished. Expectations for Palantir are incredibly high, and even a slight miss or an overly cautious outlook could trigger a decline in share price. From a broader perspective, there are numerous other companies trading at far more reasonable levels that may offer better opportunities for long-term investors. While Palantir is undoubtedly a fascinating business with compelling technology, its stock may not offer the right balance of risk and reward at current levels. Until the price more accurately reflects the company's actual financial performance and near-term growth prospects, it may be prudent for investors to look elsewhere. In the end, Palantir Technologies remains a highly debated artificial intelligence stock, with its current share price sitting around 25% below its all-time high. As the company prepares to release its Q1 earnings on the 5th of May, investors anticipate significant stock movement given its history of double-digit swings after earnings. Management is forecasting 36% revenue growth, matching the previous quarter, though it often surpasses its guidance. Despite having only 711 commercial clients, Palantir's software commands a high average customer value of over $2 million annually, reflecting its premium positioning. However, the company's valuation, at nearly 80 times sales and 167 times forward earnings, raises concerns, especially when compared to typical software peers trading at 10 to 20 times sales. Unless Palantir achieves sustained revenue growth of 40% or more over several years, its current valuation may not be justified, suggesting potential downside risk following its earnings report. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.